what we are going to start the conversation around is the premise of which deals work and which don't, and how might you measure that type of a question of which deals from a portfolio of very active deal makers are the ones to really zero in on. So let's start with the most basic measurement question. What metrics have you found to be effective in measuring deal success? Michael, do you want to go first, or Lisa?
So can you guys hear me okay? Yeah? All right.
Do you want to just quickly introduce yourself? We've got your title.
Oh, sure.
It'd be helpful if you just gave a quick intro, too.
Sure. So Lisa Marchese, I head our corporate development group at American Express, which means I have our ventures portfolio as well as the M&A integration and separation function. I've been at Amex for 17 years, and so have seen my share of deals, including one that we did with GE, not with Mike, unfortunately. But totally happy to be here and give you guys some perspective on how we think about the deal world.
And Mike, you want to do a quick intro, and then let's get into this question of Dealmetrics.
So Michael Jones, I'm a corporate development M&A guy at GE. I've been at GE for 20 plus years, always in a transactional strategy type of role. Lived abroad for 12 or 13 years as part of that. The UK, London, Connecticut, which is where I grew up, was abroad. And prior to that, I worked in investment banking for a decade or so. So I'm a partially recovered investment banker. So I probably still have some faults from that period of my life.
Recovering well, which is good. So you've both worked on a lot of deals, you've closed a lot of deals, and you've probably been asked a number of times, were those deals successful? How do you measure the success of a deal?
So I'll start. We have it's always easy to talk about the policy that says we go report out to our deal committee on a 12-month and a 24-month basis how well we have done. As a practical reality, if it's a portfolio acquisition, it's really hard to find 12 months, 6 months, 9 months after we buy it because those card members become integrated into the rest of our card business. If it's a capability that we've bought and we're not using it as a revenue generating company, but we're using it to support a customer experience or satisfy a technology gap that we had, it also is a little bit harder to then go back. And so while there's a whole bunch of financial metrics that we use, I think it's really a case-by-case basis, and it leads to a lot of debate around, was it a good acquisition? The only other metric that I could tell you that's like really clear is I've also bought and then subsequently sold things, so that would be no.
Although,
those are the easy ones to say they didn't work.
Depends how much you sold it for.
Yeah, if you sold it at a high price, I think we should give you some credit. So now, when you think about this question, can I challenge you to drill a little deeper too? Are there metrics that you think you can use across multiple deals, and then also metrics that would be different depending on the type of deal that was involved?
So we look at a lot of like return and IRR metrics are the most easy to use. But I guess, again, what I would say is being able to track through. We don't flag all of our customers. If we buy a portfolio with 500,000 customers in it, we don't flag them all, so I can't then go out and try and 2 years later find those 500,000. In the first 6 months you can track it. It just gets harder and harder to do. So we'll look at the overall business that acquired, and are they continuing to grow a comparable portfolio, and we'll credit that to success metrics for the deal. That's very different than like a company that we have bought, run as a standalone company, it has a standalone P&L, and there we track returns, we track P&L metrics, we track customer acquisition metrics. It's like a very different tracking.
Similar. I mean, we have a range of businesses. We do transactions ranging from tiny little things all the way up to multi-billion-dollar transactions. But and similarly, there are some financial metrics that everybody in this room would recognize. Not too many of them that are specifically looked at as part of tracking acquisitions. That is fairly straightforward, and it's very much versus what your assumptions were. The debates both going in post-deal integration and looking at things retrospectively are about some of the other more, I'd call them softer, maybe not softer, but strategic benefits, so to speak, or what your value drivers that you have identified for doing the deal. Obviously, GE is a fairly financially oriented company, so there's a heavy weighting towards the financials. But then that sort of debate on what you're trying to accomplish strategically informs how we think about integrations and what we do, because every integration is completely different. So I think probably similar to American Express, but everyone's not created equal. But there is a basic sort of block of financial metrics that we look at, and we try to say at least 3 years. In some cases, we've had businesses for 10 plus years, and theoretically, you could look back to when you acquired it. And other ones, frankly, that within 6 months, it's not worth the effort to kind of track it. We as a company, every 3 years or so, and our board's super engaged in this, and they actually love it. We do a acquisition retrospective. Not every single deal, but more or less every acquisition over $50 million, which is not a small set for us. And we try to, we start with the financials, and then the real debate is sort of what we learned, what went right, what didn't go right. There's a lot of things that don't go right, and we try to, inform our other decisions. And it's really important for our board to try to understand, as they are an integral part of the capital allocation decisions in the company, understand where we're good and where we're not.
Just a basic mechanics question is it every 3 years so that deals are at different levels of post-close maturity? Is that right? So
Yep.
The board isn't looking at them collectively on each one 3 years post-close.
No.
It's just a point.
It's rolling 3 years.
And as a corporate development person, of the financial metrics that the board is looking for, are there some that you think do a better job of capturing the value drivers than others, and that you'd recommend maybe there's more emphasis, and again, specifically to the financial metrics?
I was going to say, to build on what you said about there's always the positives and the negatives of the deal, it's risk, right? And whatever plan somebody shows me to justify an M&A case, I'm like, okay, well, I just know it's wrong. I can't tell you how it's going to be wrong, but I can tell you it will be wrong. And so what we look at is not a specific set of metrics as much as tell me what the 3 drivers were of value in the deal. And then we do the waterfall charts of red and green. And so the green parts are where you did way better than you thought you were going to do. The red parts are the places where you didn't get whatever value you thought you were going to get. And then there's a third, hopefully, green bar that is about all the things I found after I bought the company that wasn't baked into my original case. So it's a more formulaic way of showing the same chart for every deal as opposed to there being a standard set of metrics, because a capability buy, as I said, is very, $15 million is different than 150, which is different than $1 billion. The drivers of what makes it successful are different, but it's a way for us to standardize how we present very disparate data, which is a little bit of a different take on it.
Very clever. That's really interesting. Thank you. Yeah. How about, I'm glad you shared that. I sort of challenge you with this, what's your favorite of the financial metrics that you think as a corporate development officer capture the story? What about non-financial metrics? And whether it's cultural assimilation, whether it's advancements in in-process R&D, are there some metrics that you find to be reasonable, to be helpful, to be insightful on a non-financial basis for measuring deals?
I mean, it's again, if you're buying a small company for some technical capability, you'd probably prioritize the delivery of whatever that technical thing they were developing. I think one that really cuts across just about everything, however, is, and we've already heard it from Lisa, is some form of customer retention, installed base retention. That's fairly universal. Sure. Now, sometimes early stage don't have customers yet, so it's probably not all that important. But our mainstream deals, somewhere in the top, and that can be quantitative as well. In the top quadrant of what's important is customer retention, We've got big service businesses, so the corollary of that is installed base retention.
If you're interested in additional information on innovation and M&A, I encourage you to check out the Transaction Advisors Institute, which is a robust source for knowledge on M&A best practice.
We host a series of M&A conferences, run an elite M&A academy, offer M&A masterclasses, conduct M&A research, organize the M&A Leadership Council, and publish a prestigious M&A journal.
Members of the Transaction Advisors Institute include corporate executives, board members, and private equity investors that are interested in understanding the critical issues impacting transaction planning, structuring, and execution.
I encourage you to get more involved in the Institute.
If you don't mind, let me get a sense too from the others on deal tracking. Could we just do a show of hands? How many people find currently that they're tracking deal performance 1 year after close? If you'll raise your hands, so 1 year is your standard? Okay, now could we do a 2 years? 2 years, are you still tracking deals as a separate entity? Because I was intrigued when Michael talked about 3 years. Anyone doing 3 years? Okay, interesting. Frank, please.
1 year. Sorry. So what we do, when everything is on track, after 1 year, we stop. If things are not on track, we might follow 3 or 4 years, right? Till things are back on track. Or at some point of time, we decide not to do it anymore.
Yeah, that's interesting. That it's not formulaic, but it's based on performance. You might roll off your monitoring status. Anyone else found anything effective in terms of deal tracking that would be helpful? Advance this conversation. I appreciate Frank's view because Frank now is a board member on multiple public company boards, but historically was a CFO and a CEO, so he's seen it from many sides. Lenny, thank you.
William, we track it first year and then second year. If everything is okay, then we stop. We like to have things in a standard way so everybody is used to that they have to come and there is no stigma to it, whether you come or not come, you know. Right. And it works for us.
It seems like that's a very reasonable and sort of balanced approach. Obviously, we're assuming, unlike a financial sponsor, there's a level of integration. And Alex, if you maybe would be game to comment on some metrics of cultural assimilation.
I was just talking about tracking, and with obviously, if there's a strong tie to performance based on earnout, then that can be a 2-year piece, and you're going to need to track it, and so that becomes an important factor. But being from Korn Ferry, I've got a bias around tracking talent, and can you keep them? What's happened to them? And if that's the basis of any of the deal thesis, I don't know if that's something that you guys track in your businesses.
Yeah.
We do, particularly when we're buying what I would describe as a capability, right? And it's not always founder CEO. So we go through a process and define who's retention talent. And so named individuals, whatever you want to call them. And that to us is who are the people that are going to help us achieve our synergies. And so for a lot of the capability buys, we look at the tech developer team, and that's our retention metric, right? Like salespeople don't matter, senior management doesn't matter, that group does. Other deals where we expect it to run a little bit more independently, we need to keep management, we need to keep salespeople. So we do have a specific statement of intent with employee retention, and we track that definitely over the first 12 months. Sometimes we only need them for 12 months, sometimes we need them for 2 years. Very rarely do we expect them to become lifetime employees of Amex.
I'd add one thing. We've got multi-businesses. The other element of how long you track is again, we sort of like to do it for 3 years, but we have within our portfolio long cycle businesses and short cycle businesses, and very short and very long. So, if you're buying an example would be buying a pre-FDA approved pharmaceutical. Tracking it for 2 years does nothing for you because you don't know. I mean, you're really, you might be 5 years out. Now you're not tracking financials if you're not selling anything, but you're tracking something else. And I think in some of our short cycle businesses, after a year or two, you probably have a pretty good idea of how things are going. So it's not at least we try not to be so sort of rigid about it must be this, because there are variations in relative to the business model as well.
The final comment that I would make on tracking, and it goes to what the gentleman said in the back, is I think it's important to have a standard that deals will be tracked, because otherwise it feels too much like a stigma for the business unit owner or sponsor. And so none of my business executives like it when I show up and tell them it's time to do the reporting out on the deal, but they also know that it's not personal. It is truly a objective review of this went well and this didn't. And the more you make that formulaic, or the more you make that just part of how you operate, particularly for companies that are not highly acquisitive. Like, you guys do way more deals than we do. We do a handful a year. Sometimes we do 1, sometimes we do 5. So that kind of cadence is important.
You're just giving me a good segue, Lisa. So this scenario that we used to structure this conversation was that, one, you might take stock every 3 years or every year on Dealmetrics and whether certain deals are performing well, and if other deals aren't performing well. And so let's assume in our scenario that we've done that, and we've gained some insight into the types of deals that have been effective, that have produced the right financial metrics, the right integration metrics. So we've figured out which deals are good. So now I assume you want to do more of those deals. Lisa, how do you recommend working well with the business units based on this analysis? So you've talked to them about the report card, you've talked to them about what's worked well. What happens next that's effective in terms of engaging on sourcing new deals? Do you use big data? Do you use customer feedback? So how do you use this deal metric review to inform what to buy differently tomorrow?
Yeah, I think so I think the sourcing part starts with strategy. I say all the time, we don't buy interesting companies, we buy strategically relevant companies. And so strategy generates a pipeline. I think the pipeline, it's partly why our ventures group helps. They see 1,500 companies or so a year, and so not all of them are good venture candidates. Not all of them are good candidates for us, period. But some of them seed an early stage M&A pipeline. And so for us, we take what we learned in terms of how to integrate what the hypothesis is going to be, and that flows through the pipeline. But I don't think we use data to generate a pipeline as much as that's like the human interaction and being in the space and in the ecosystem. So once we've identified a group of companies, we try and use tools that are available to understand who their talent is. There's companies out there that will screen resumes of talent, that LinkedIn profiles, and give you a profile of the company. And so we try and use some of those types of technology-driven solutions to help us after we've identified companies. But I think the sourcing is something that it's a lot of personal interaction.
That's great. Wow. And I want to challenge Micah with the same question, because we see the proverbial best practice espoused by firms that say big data is the answer to all the questions, that using analytics and using massive data sets, we can see opportunities. We can see deal pipelines where there's talent, where there's growth. Is this really practical? Is this really helpful? Is this just consultant speak, or is this the real world?
At least from our vantage, it's not similar to what Lisa just said. On the pure sourcing, let's use big data to tell us who we should buy. Call me a dinosaur, but that's just not the way we do it. Now, I would never rule it out, because I think some of the more further downstream uses of data, like some of which Lisa referenced, are very incredibly valuable. Challenging your basic assumptions, understanding, you may have a great business leader, they may be a terrible business acquirer, just in terms of integrating. It may be a good company, and it's just not their thing. So what risk, where your value drivers are, and synergy attainment. I think that's where, at least so far, now some of that informed sourcing, but I'd call the sourcing is everybody, people have broad networks. There are people who are in the industry every day with customers, clinicians, power providers, you name it, that are, in our experience, a much richer source of ideas than we've seen in a true sort of big data.
Yeah, it's exciting, and it's enticing to think that we'll be able to sit like an institutional investor and slice and screen and find through big data sets acquisition targets that meet a criteria and really fuel a pipeline based on the same types of metrics we use in our portfolio review. I don't think we're there yet. Do you think we'll be having a different conversation in 5 years?
5 years in my mind feels like a short time horizon. I guess what I would say is anytime somebody comes, like, consultants or bankers, and says, oh, I've done the screen, and I started with every single company in the United States, and then I filtered it by these criteria, and they come up with the 5 at the end. I'm like, well, I could have told you those 5 without going through that process.
Little data.
So until that data algorithm input mechanism creates an answer that's both unexpected but then also actionable, we're just creating lists. And I think 5 years is a very short time frame for that to get totally weeded through the system.
Before we move off of this concept, has anyone had success with tools or platforms for deal screening that it was insightful yet? I think this is still not yet in common practice. I think this is an emerging area, but if there are any innovators out here, please share. But here's where I think a lot of the deal flow probably comes from, is the bankers. And that can be good and bad deal flow. But tell us, in your experience, how that's worked well. Tell us any lessons learned from that experience in fueling the pipeline with deals that the bankers are showing you, and to what degree is there an interplay, if at all, with this earlier portfolio review, right? So we've studied the portfolio, we figured out which deals we like. Are the bankers in the loop on that? Are they feeding you deals that align with those metrics?
I think there's a difference between where your ideas are coming from and where the flow is coming from. As a longtime corporate development professional, honestly, if a banker walks in with a new idea that we haven't thought about 100 times, you should be embarrassed. You're in the wrong job. It really, and it's not like pride of authorship, it's just you're in the industry every day. Now, that being said, just about every transaction that happens has a banker on one or both sides or more. So I differentiate. I think there's a big difference between where your ideas come from, and then there's another way as a corporate development person, how you get into actionable situations. But they're not. Everything's not actionable, and that's where obviously if somebody's retained a bank, it's probably a little more actionable than not. But I view them as very different.
I would agree with what Mike said wholeheartedly. And I think for us, when we do things that are small, the capability buys that are, $10, $50 million, a lot of those, they're too early for bankers to see. And so we get a little bit more of that flow from some of the VC or the private equity firms because it's just earlier stage. I think the bankers are helpful in the sourcing insofar as if I say, I am looking for this type of B2B payments capability in these geographies, when something's for sale, they'll come tell me. Or they'll be like, you should go have a proactive conversation with this company because I know they're thinking about their strategic options. That's the value of bankers. But I agree with you. If somebody comes in and tells me something I haven't ever thought of, it's time for me to retire.
Let's spend just a short time on then, once the deal's been identified, the diligence process. And again, your recommendations and perspective would be really valued here, because again, we're looking at this emerging dialogue around analytics and big data and challenging whether that's helpful. Are there analytics and diligence that you found to really be insightful and help you negotiate a better deal? And if so, what really rises to the top in terms of any analytical review beyond the sort of basic DCFs and other metrics? But is there anything clever, is there anything interesting that you found to work in terms of the use of analytics and diligence?
I think there's a wealth of information out there about all of us as individuals, about individuals at companies, about companies. And at a minimum, whether it's changing the way you negotiate the deal, I haven't necessarily seen that yet. But I think it's an increasingly important part of how you underwrite. I mean, there's a lot of knowledge you can get about people's resumes, how long people have been at one. If you're buying a small company of 20 people, and the average tenure for their career is 6 months in any one company, you probably shouldn't bank your value drivers on all of them staying around forever.
And you can find it in 10 minutes on LinkedIn.
10 minutes,
you don't have to ask them for.
So I do think in terms of helping how you think about underwriting, there is a lot of information, and it's that was not something even 10 years ago. It was all very manual, and you'd be calling people, you'd hire sometimes a consultant to do people checks and things like that. There's a lot more information on product quality issues. I mean, you name it. And these are private companies, public companies. Presumably, you can get a lot more information about.
I also like the comment that you said in our prep call about, as a seller, the ability to watch where people are in a virtual data room, where they spend their time, how many people look at different reports, is very insightful in terms of understanding the mindset of the buyer. And you couldn't do that before when it was like a paper-based diligence, right? And so I think on that side too, I thought that was incredibly helpful.
Yeah, and it's both sort of a individual buyer, but and assessing whether or not they're legit or not. It's obvious if somebody's spent a half an hour in a data room, they're probably not that serious. But you also see you have the ability now to look across, if you have some sort of a formal process, multiple participants, and not just sort of how they're each tracking, called in seriousness, but what they're looking at. If all 20 people in a process start digging in on product quality, there's probably some information out there on the internet about product quality, because they shouldn't necessarily know that. So it's really super insightful, and more so on the sell side than on the buy side so far on terms of analytics.
I don't think we've refined our discussions enough on the use of analytics increasingly having value, but on the sell side different than on the buy side. I think we're still challenging this question of how it might help on the buy side, but I think that may be really the area where you're starting to look at innovation in your M&A process, that's really the place to focus. So interesting insights from the data room and early warning signs as to the questions that are going to be probed probably at diligence. But even stepping back from the process, can we first talk about the sell side from the perspective of a portfolio review, right? So we've talked about whether it's 1 year or 2 years or on a 3-year basis. You find there's deals you like that are very accretive and strategic. There's deals that have been mediocre, and there's deals that just didn't work out. It's an imperfect science, right? So you do these portfolio reviews and you find assets. How do you get to the next stage of actually getting a commitment to a sell side process, to a spin-off? Because I imagine there's a management bias against it when you're talking about working with the business unit leaders. You show the report card, I bet they'll tell you they can turn it around every time, I'm sure. But how does that process work well and in a constructive way when you really need to have that hard conversation, either because it's underperforming or a hard conversation because it's so strong and it's time to realize the value? What have you found to be effective?
So we can talk a little bit about, it is a hard conversation with the business unit owner, and there is, in my view, a sell it while it's at its peak. Don't wait till you've milked the cash cow business to sell it. And that's where we tend to have a lot of debates. And those are on the I would say the smaller transactions where the individual business owner is more concerned about the grow over because they've now taken a hit to revenue and PTI, but their targets haven't changed for the following year. And so there's this grow over challenge. The gain doesn't cover it. That's different than sizable transactions. Like when we spun off our business travel business, we looked at the return thresholds and the metrics, the financial metrics, and the way we invested in our travel business versus our card business. And we were slowly starving the travel business. And so by creating a joint venture with a financial sponsor, we freed up capital. We put in a management team that like understood travel, and we grew the business fundamentally differently than we ever could have as an American Express business. It had a travel cost structure, not an American Express cost structure. So there's a lot of places where a partial exit or a full exit helps to realize the full potential of the business that you're selling. That the larger the business, I actually think it's easier to have the conversation internally because you can point to other comparable transactions, like scale matters. And so that's some of where our debate happens.
And I love the way you characterize it too, that a lot of times it's sell it at its peak or sell it where there's a big problem, but there's even a middle ground as well, where it's just not the highest and best use. It may not be at a peak and it may not be a disaster, but it's still, it might be interesting to free up the cash in a different structure. It's really interesting.
I think we'd like to think of it as not just sort of acquisitions you did and keep looking at them. We try to look at the entirety of our portfolio down to, we call our big sort of name businesses tier 1 and tier 2, or sometimes even tier 3 businesses, because by the time you get to tier 3, they're really not true businesses usually. But and we try to look at those. We not try. We do look at those. We like to think we exercise decent portfolio hygiene on a regular basis. Probably annually. Data enables you to do that sort of more real time. You're not going to be reviewing your portfolio every day of the week. And we, there's, between it's a bad business to it's a valuable business, more valuable business. There's 100 different reasons why you might sell or reallocate capital. Somebody else may be a better owner of it, and so theoretically they'll pay you a lot more than it's ever going to generate value for your shareholders. Those are a little less straightforward discussions because you don't know necessarily if somebody's going to value it at more than you would. I think we try to get to a place where do we add value to a business or not? And if the answer is not, over time, generally speaking, unless you're lucky, you probably will depreciate value. But that's a sort of a regular process. And similar to what Lisa said about setting the cultural expectation that we're going to do this. If you showed up every once in a while, sort of episodically saying, "Hey, we're going to do a portfolio analysis on your business," like the decision has been made, right? This is just cover. But if you're just doing it as a regular part of sort of one of the ways you operate your businesses, it actually generates healthy discussions about what we're doing well and not, just in our day-to-day businesses before, forget about acquisitions.
And I think it probably gets you out of what I like to call gain hunting, because I used to have business partners who would show up and say, if I can get a gain of at least X million, I'm going to sell the business. I'm like, no. We're either going to decide to sell it or we're not, but we're not like gain hunting, because you have to make the strategic decision if you're to what you said, are we a better owner or not? If we're not, figure out what you think is the maximum value that you can get for the business and try and attain that. But like trying to set a gain threshold over which I will or will not sell leads to, trying to sell businesses 3 or 4 times. And then you have that asset in the market that people are like, oh yeah, they tried to sell it last year. They're back on the market again. That is never a good place to be. Yeah. Speaking from personal experience.
A friend once had this problem, right?
Exactly.
Yeah, it's interesting, of course. And then you don't know what gain you're really going to get before you take it to the market and create a big mess, right? So you've got to have a conviction, it sounds like. In both of your comments, you used the word we, and I want to drill into that a little bit. You said, we would do a review. What would you recommend in a perfect world, is the composition of that reviewing body? Is there a board member? Is there a special committee? Is it the business unit leaders reviewing themselves? Are the business units too biased to be on the table? Is it corporate development only? Should it be investment bankers or a group? What's that perfect composition to do that type of review?
I don't know if there's a perfect composition. I mean, at some level, just about everybody you've mentioned could be involved in some part of the process. I think, I would probably say again, GE may be different than some other companies in the room, but we have multiple businesses and multiple industries, and but we try to do it both from a bottoms up. This is the business. I mean, it's the way they run their business too. This is how we create value. This is why this business is strategic, et cetera, et cetera. But you have to do it at some level, tops down too, because while the person in business XYZ may think that it's totally on strategy, whatever they're doing, at the company level, again, multi-industry, you may say, you know what, bigger, better use somewhere else. We don't believe that those opportunities will come real, or any number of other things. And I think if you wanted to be, there's a balance between, as I said, sort of doing it so frequently that it maybe loses its oomph. But at some point, I would assume, our view is the answer has to be yes. Your board has to see this work. Now, maybe not the gory detail that you might do at the more of the operating level, but our view is we owe it to them to have a realistic view on the portfolio composition.
Lisa, if you were hypothetically putting the perfect team together to do a portfolio review, who would be the participants in this hypothetical?
So it's interesting because we debated early on whether Corp Dev was objective enough to evaluate its own transactions, right? Which is funny. And then I think outsourced it to a finance function, but then the finance people kept coming back to us to ask all the deal-related questions because they didn't have the context and the history. And so we run the process, and I think part of what gets us the credit for being objective is I'm also the first one to raise my hand and say, we missed this from a deal standpoint versus it always being the business people didn't do it, so there's full transparency and accountability. I think for us, the way we think about it, and again, we don't have as many acquisitions or divestitures, but it's the board sees the larger ones. I think on a regular basis, it is what we call our executive committee, our deal committee, and that is our CEO and his direct reports. So we get both business people as well as our functional leaders, whether it's HR, legal, risk, technology. Because at the end of the day, as an integrated payments company, this is the group that lives with what we do. And so that's, less business unit specific things, but that's how we tend to do our deal reviews. But I think Corp Dev and some really good finance people who can be objective about the numbers, because we all know the numbers can tell whatever story you want them to tell, I think is where we start.
I was thinking, I've left off at least I right away thought of two groups in my quick list. Tax and anyone from the M&A HR function, culture. The cultural impact of carving out and spinning off a unit is probably a challenge. So in a perfect scenario of a portfolio review team, maybe that's an important party. And certainly we look at structures like a reverse mortgage trust and the ability to do a tax-free spinoff. Again, that's maybe somebody that should be at the table in this perfect world that we're sort of envisioning and debating. Who else should be part of that? I mean, one thing we didn't talk about is external consultants. Guys like Seth, does this work all the time. Who else should be at the table for these portfolio reviews, especially if a divestiture is potentially within the scope? Any other thoughts or comments on this?
Yeah, just on the phone. On the phone. So we're finishing up the
I think Elizabeth's got a microphone.
Come on in.
Well, let me do a show of hands. Does anyone use external consultants for a portfolio review? Any versus internal? I think we've got a question here.
No, I was just going to say anybody that's going to be involved in the next transaction, especially the next transaction in the similar, for the same business unit. I mean, they're the ones that are going to learn from it and be able to take something from that review other than just reporting on performance, but actually use it to shape the next decision.
The next deal. Yeah, it's interesting. Yeah.
Look at me walking.
And, I didn't suggest investment bankers, but, their answer was, my former colleagues, Nora and I used to work together in an investment banking firm, and the answer was always to do a deal. Whatever the question was, the answer was we should do a deal. But obviously you could have them in the room, but I think we might all know their answer. Who else could help us think through this question?
If you use the consultant, like McKinsey or BCG or whatever, to do the deal, and it's a big deal, then maybe when you do the review in a year or two, you might invite them.
Yes.
That's a special case.
That's a good thought, that and I think Lisa touched on this too, that an effective portfolio review process and team would have a continuity from having done the deal to begin with, right? And so you understood the value drivers and you understood the objectives at the onset, and then you can consider whether the market or the business can continue to produce against those value drivers or not, and consider an alternative. I think that's a really interesting thought, is that if you don't have that organizational history, and as fresh as it sounds to have this outside advisor, challenge if you don't have the internal data and metrics, that can be limited. Although independent, it can be limited. So,
and I think, I don't know, Mike, what you would say, but I think for us, I mean this in the nicest possible way, but like getting to signing, even to closing, is like the easiest part of the deal. Living with it, integrating it, that's where it's successful or not. And so, to me, I think there are things that I would do differently in a deal or negotiate a different price point, maybe. But at the end of the day, whether we overpaid or underpaid for an asset, if we don't get my red and green bars to work of value creation, and that is by a business and an integration team who's going to tweak things, like we talked about the candy bars, right? Tweak the cultural things that need to be tweaked, or repivot the tech platform, or re-engineer a product that could work better a different way. Like, that is what happens 6, 12, 18 months post signing of the deal. And so I think the bias that we have is the people that are responsible for that are those that help generate the lessons learned. And it's not just about the numbers, right? I mean, the numbers help tell the story, but it's not just about the numbers.
Well, I think we've taken away a couple of thoughts. I mean, certainly don't overplay the use of big data and analytics yet, maybe on the sell side, but don't spend and waste a lot of time looking for an answer there. We've talked about the use of metrics, both financial and non-financial, that are different, but yet against a common scorecard. I thought that was very clever, so thank you for that. Certainly I think this idea of looking at divestitures at a peak, at a trough, or even midstream and highest and best use is pretty interesting. And getting hopefully the right team in the game is a big part of having then a good outcome, and that cohesion is pretty interesting. So I really appreciate the comments and your suggestions and guidance for all of us, and those from everybody in the room.